Let me tell you something you probably don't want to hear. Most people who call themselves investors aren't investors at all. They're shoppers. And shoppers never get rich. I know that sounds harsh, but I've spent decades studying the markets, and I've watched this pattern repeat endlessly. Smart people, educated people, hardworking people, all making the same fundamental mistake. They treat stocks like products. They approach investing the way they approach buying a new phone. They want the latest model, the trending item, whatever everyone else is buying. And then they wonder why their portfolio never grows. It's because they're not investing. They're shopping. Today, I'm going to show you the difference between a consumer and an investor. It's a simple shift in thinking, but it changes everything. If you understand this, you won't just fix your portfolio. You'll transform your entire relationship with money. So let's begin. Think about someone you know who buys a new iPhone every year. The old phone works perfectly fine, but a new model comes out and suddenly they need it. Why? Because it's trending. Because everyone's getting one. Because the old one feels outdated. That's consumer mentality. And it's completely natural. We're wired to be attracted to new, shiny, popular things. Our brains release dopamine when we acquire something fresh and exciting. But when this mentality enters the stock market, it becomes destructive. I've watched brilliant people, engineers, doctors, lawyers, people with exceptional minds and discipline, turn into children when they start investing. Why? Because they're thinking like consumers, not owners. A few years ago, I met a man at a conference, MBA from a top school, 6-figure salary. He told me, "Marcus, I bought Tesla. Everyone's talking about it. Elon Musk is a genius. The stock's going to 10x. I asked him, "Did you look at the company's fundamentals? The balance sheet? The competitive landscape?" "Well, no. But everyone says it's the future." He wasn't an investor. He was a consumer chasing a trend. To him, Tesla was a status symbol, not a business. And this isn't just about Tesla. Every bull market produces these patterns. Dot-com stocks in the late 90s. Real estate before 2008. Bitcoin. NFTs, meme stocks. The names change, but the stupidity doesn't. People chase the next big thing because their brain tells them, "Everyone's buying it. I need to get in before it's too late." That's FOMO, fear of missing out. It's the same feeling you get at a department store during a sale. If I don't buy now, it'll be gone. But here's the fundamental difference between investing and shopping. When you buy a product, you get instant satisfaction. New phone in your hand, joy. New car to drive, excitement. Your brain releases dopamine. It's a biological reward. But investing offers no instant satisfaction. You buy a stock and the price just sits there. Sometimes it drops. There's no thrill, no unboxing moment, just a number on a screen. So people get bored. They crave excitement. They want action. And when they want action, they start trading. I knew a dentist once. Very successful practice. In 2020, out of boredom during lockdown, he opened a Robinhood account and started day trading. Options, penny stocks, SPACs, anything that moved fast. Within 2 years, he'd lost 40% of his savings. Why? Because he wasn't investing. He became an adrenaline junkie. Every day a new stock, a new trade, like buying a new gadget every week. He turned into a consumer in the market, and I see this pattern everywhere. People don't understand that the market isn't a mall. Shopping doesn't make you rich here. You have to become an owner. But ownership is uncomfortable, because owners have to wait. Owners need patience. Owners must embrace delayed gratification. And our brains aren't wired for that. We're wired for instant rewards. That's why 90% of people shop when they think they're investing. Let me show you how real investors think. Howard Marks tells a story I've always loved about the difference between consumers and investors. Imagine two people walk into a Coca-Cola store. The first person buys a Coke, drinks it, enjoys the sugar rush, and leaves. The second person doesn't buy a Coke. Instead, they buy shares of Coca-Cola. The first person got instant satisfaction, 15 minutes of pleasure. Then it's gone. The second person got nothing immediate. No taste, no sugar rush, just a piece of paper, or more accurately, a digital entry in a brokerage account. But here's what happens next. Every quarter, Coca-Cola pays a dividend. That dividend comes from millions of people around the world buying Cokes. The person who bought the drink paid Coca-Cola once and got nothing lasting. The person who bought the stock gets paid again and again for decades. That's the owner mindset. Owners don't care about the product. They care about the business. They care about cash flows, competitive advantages, management quality, and long-term durability. They ask, will this business still be making money in 20 years? Consumers ask, is this popular right now? Howard Marks learned this lesson early in his career. In the 1970s, he watched people dump solid businesses because they were boring. Utility companies, insurance firms, consumer staples. Everyone wanted exciting new tech stocks. Then the market crashed in the early 70s. The exciting stocks went to zero. The boring businesses kept paying dividends. The consumers went broke. The owners got richer. Here's another way Howard Marks explains it. When you go to Walmart and see a sale, what do? You buy more. You think, great, I'm getting a discount. But when the stock market has a sale, when prices drop 20%, 30%, what do most people do? They panic. They sell everything. They run away. It's completely backward. Why? Because they're still thinking like consumers. Consumers hate when the products they just bought go on sale. It feels like a loss. I paid full price yesterday and now it's cheaper? I got ripped off. But investors should love market crashes. It means quality businesses are on sale. Howard Marks has written about this extensively in his memos. He says the best opportunities come when everyone else is panicking. When fear dominates the market, that's when prices become irrational. That's when owners step in. I watched this principle play out during the 2020 COVID crash. In March, the market dropped 30% in a matter of weeks. People were terrified. They sold everything. I was buying, not because I'm smarter, but because I remembered what Howard Marks taught. I asked myself, will people still drink Coke in 5 years? Will they still need insurance? Will they still use Microsoft products? The answer was yes. So I bought more. By the end of 2021, those investments had doubled. The people who sold in panic, they locked in permanent losses and missed the recovery. That's the cost of thinking like a consumer. Our brains are wired for instant feedback. It's evolutionary. For thousands of years, humans needed immediate rewards to survive. Find food, eat it now. See danger, run now. In the modern world, this wiring doesn't serve us well, especially in investing. Amazon Prime trains us to expect 2-day delivery. Netflix trains us to binge entire seasons instantly. Social media gives us dopamine hits every time we refresh. We've become addicted to speed. But wealth doesn't work that way. Wealth is built slowly. Compounding takes decades, not days. I once met a software engineer in Silicon Valley. Brilliant guy. He bought shares of a great company, a steady, profitable business with a strong competitive moat. Within 6 months, the stock had gone up 15%. He sold. Why? Because he was bored. 6 months felt like forever. He wanted excitement. So he took his gains and started chasing momentum stocks. Within a year, he'd given back all his profits and more. If he'd just held that first investment for 10 years, it would have grown 400%. But he couldn't wait. He needed action. This is the curse of instant gratification. It turns investors into traders. And traders, statistically, lose money. Howard Marks talks about this psychological trap constantly. He calls it the need to do something. Investors feel like they have to act. They can't just sit still. So they trade, they tinker, they chase performance, and they destroy their returns in the process. There's a famous study, the marshmallow experiment from Stanford in the 1960s. Researchers put a marshmallow in front of young children and told them, you can eat this now, or wait 15 minutes and get 2 marshmallows. Most kids couldn't wait. They ate the marshmallow immediately. But the kids who waited, who delayed gratification, went on to have more successful lives. Better grades, better careers, better financial outcomes. Investing is the adult version of the marshmallow test. Can you sit on your hands and let compounding work? Or do you need to act, trade, do something? Most people fail the test. I've made this mistake myself. Early in my investing journey, I sold a position too soon because I got impatient. The company was performing well, but the stock price wasn't moving fast enough for me. So I sold and moved on. That stock went on to 10x over the next decade. I didn't need to be smarter. I just needed to sit still, but I couldn't. I had the itch to do something. It cost me a fortune. Howard Marks often says that the best investors are the ones who do the least. They find a great business, buy it, and then do nothing for years. They let time do the work, but doing nothing feels wrong. It feels lazy. So people tinker, they trade, they optimize. They convince themselves that activity equals progress. It doesn't. In investing, activity equals cost. Every trade has fees. Every sale triggers taxes. Every decision introduces risk of error. The more you do, the more you bleed. Howard Marks puts it simply. The market rewards patience, not activity. But patience is uncomfortable. Patience means watching other people make fast money while you sit still. Patience means enduring boring stretches where nothing exciting happens. And our consumer brains hate boredom. Here's another problem with thinking like a consumer. You start measuring success by what other people have. Consumers are obsessed with comparison. My neighbor has a Tesla. I need one too. My coworker went to Bali. I should book a trip. My friend's trading account doubled this year. What am I doing wrong? This is envy. And envy destroys portfolios faster than any market crash. Howard Marks writes about this in his book, The Most Important Thing. He calls it one of the most destructive emotions in investing. Why? Because envy makes you abandon your strategy and chase what's working for someone else. I've watched successful people with solid portfolios blow themselves up because they couldn't stand seeing others make more money faster. There was a lawyer I knew, mid-50s, solid career, disciplined saver. His portfolio was growing steadily at 8 to 10% a year. He was on track for a comfortable retirement. Then his golf buddies started bragging about crypto gains. One guy turned $10,000 into $100,000 in 6 months. Another bought an NFT at 5x the overnight. This lawyer couldn't take it. He felt like he was missing out. So he pulled money from his boring index funds and dumped it into speculative crypto. Within a year, he'd lost half of it. The buddies who bragged, most of them lost their gains too, but they had steady incomes to recover. This lawyer was nearing retirement. He didn't have time to rebuild. Envy cost him his financial security. Here's the brutal truth. There will always be someone making more money than you, and they'll always be louder about it. The guy who 10x'd his money on GameStop will tell everyone. The 100 people who lost money on GameStop will stay quiet. Survivorship bias makes you think everyone's getting rich except you. But it's an illusion. Social media makes this worse. You see people posting their wins, their new cars, their vacations. You don't see their debt, their stress, or their losses. So you think you're falling behind. And when you feel behind, you take risks to catch up. That's when disaster strikes. Howard Marks teaches that real wealth is quiet. The flashiest people are usually the most financially fragile. They're consumers playing a status game. Real investors don't care what anyone else is doing. They don't measure success by comparison. They measure it by, am I on track for my goals? Is my capital safe? Am I compounding steadily? That's it. Howard Marks also warns about what he calls the herd mentality. When everyone's piling into the same investment, that's usually the worst time to buy. But our social instincts tell us to follow the crowd. We feel safe when we're doing what everyone else is doing. That's how bubbles form. And that's how fortunes get destroyed. When you stop comparing yourself to others, you stop making stupid decisions. You stop chasing trends. You stop gambling to keep up. You become an owner, not a competitor. So how do you make this shift? How do you stop shopping and start owning? It starts with one simple question. Every time you look at an investment, ask yourself, would I want to own this business for 10 years? Not trade it, not flip it, own it. If the answer is no, don't buy it. I don't care how hot the stock is. I don't care how many people are talking about it. If you wouldn't own the business, don't own the stock. This one filter eliminates 90% of bad investments. Would you own a meme stock for 10 years? No. Would you own a company with no profits and a charismatic CEO? No. Would you own a business you don't understand? No. Suddenly, your options narrow. And that's a good thing. The second step, think like a business owner, not a stock trader. Howard Marks emphasizes this constantly. When you own a business, you care about revenue, margins, competitive position, management quality. You don't check the price of your business every day. You focus on whether it's making money. Do the same with stocks. Stop obsessing over price movements. Start focusing on business performance. Is revenue growing? Are margins stable? Is the company gaining or losing market share? If the business is healthy, the stock price will follow. Maybe not today, maybe not this year, but eventually. Jeff Bezos didn't check Amazon's stock price every day when he was building the company. He focused on serving customers and growing the business. The stock took care of itself. You should think the same way. Third, ignore the noise. Turn off CNBC. Stop reading hot stock tips. Unfollow the Twitter accounts screaming about the next 100 bagger. It's all noise designed to make you feel like you're missing out. You're not missing anything except anxiety and bad decisions. Howard Marks famously doesn't watch financial television. He doesn't follow market pundits. He reads financial statements, annual reports, and industry analyses. That's it. When you eliminate noise, you eliminate the temptation to act on emotion. Fourth, build positions slowly and hold them. Consumers want everything now. Owners are patient. They accumulate quality businesses over time and let compounding work. Howard Marks built his fortune at Oaktree Capital by being patient. He didn't chase quick wins. He identified undervalued assets, bought them when no one else wanted them, and held for years while the value compounded. I'd rather own a small piece of a great business for 20 years than trade in and out of mediocre ones. Think about this. If you bought Coca-Cola stock in 1990 and just held it, you'd have made 10x your money through a combination of price appreciation and reinvested dividends. You didn't need to trade. You didn't need to time the market. You just needed to own a great business and wait. That's the power of thinking like an owner. Now, let me add something important here. This doesn't mean you never sell. But when you do sell, it should be for business reasons, not emotional ones. I've sold positions before, but it's always been because the business fundamentals changed. Maybe management deteriorated. Maybe the competitive advantage eroded. Maybe the industry shifted in a way that hurt the company's prospects. Those are rational reasons to sell. What's not rational? Selling because the stock went down 10%. Selling because you're bored. Selling because your friend told you about something better. Those are consumer reactions, not owner decisions. Here's a framework Howard Marks uses. Before you buy anything, write down exactly why you're buying it. What's the thesis? What would have to change for you to sell? Then, when the stock moves, go back to that thesis. Has anything fundamentally changed? If not, hold. If yes, reconsider. This simple practice has saved me from countless emotional decisions. Another thing, diversification matters, but not the way most people think. Consumers diversify by buying a little bit of everything. 20 stocks, 30 stocks, 50 stocks. They think more is safer. But that's not true diversification. That's just owning the index with extra steps. Howard Marks teaches that real diversification means owning businesses that behave differently in different environments. A utility company and a tech company. A consumer staple and a cyclical stock. Businesses that zig when others zag. But here's the key. You still need to understand every single one. If you can't explain why you own something in 2 sentences, you shouldn't own it. Quality over quantity. Always. I'd rather own 5 great businesses I deeply understand than 50 mediocre ones I barely know. Here's what most people don't want to hear. Building wealth is boring. It's not exciting. It's not glamorous. There are no fireworks, no celebrations, no viral moments. You buy quality businesses. You reinvest dividends. You wait. That's it. Consumers crave excitement. They want to feel smart. They want stories to tell at parties. Owners accept boredom. Because boredom in investing is where wealth is built. I've been studying Howard Marks' work for years, and one thing he emphasizes over and over is this. The best years in investing weren't the exciting ones. They were the quiet, boring years where nothing dramatic happened. The business kept making money. The dividends kept coming. The value kept compounding. That's how you get rich. Not through brilliant trades or perfect timing. Through relentless, boring consistency. But our culture glorifies action. We celebrate day traders and crypto millionaires. We don't celebrate the dentist who maxed out his 401k every year for 30 years and retired with $3 million. Yet the dentist is the one who actually won. Howard Marks once said something that stuck with me. The road to long-term investment success runs through risk control more than through aggressiveness. In other words, it's not about swinging for the fences. It's about not striking out. The uncomfortable truth is this. If you want to be wealthy, you have to be willing to be bored. You have to resist the urge to act. You have to ignore what everyone else is doing. You have to think like an owner, not a consumer. Let me leave you with this. The market doesn't care about your shopping habits. It doesn't reward excitement or activity. It rewards ownership and patience. Howard Marks has spent over 50 years proving this. His success at Oaktree Capital came from one simple principle. Think like an owner, not a consumer. Next time you look at an investment, ask yourself, am I buying this because it's popular or because it's a great business? Am I thinking like a consumer or like an owner? That one question will save you from more mistakes than any strategy or system ever could. Stop shopping. Start owning. The shift is simple, but it changes everything.